Most people still measure a software company by how fast it grows on the surface. But that number tells almost nothing about its actual strength. A company can double its revenue every year and still walk straight into decay if the customers that built that revenue quietly erode underneath. This is the paradox of SaaS. Growth looks loud, but survival is silent. Hidden behind every chart is one number that exposes the truth of whether the business is compounding or collapsing, and that number is net revenue retention. In plain words, it measures what happens to your existing customers after 12 months. If you started the year with $100 of recurring revenue from them, how much do they pay you now? If the answer is still 100, you have perfect gross retention. If they churn and you drop to 90, your base is shrinking. But if they adopt new modules, add seats, or upgrade tiers, and the total climbs to 120, you have one of the most powerful dynamics in all of business. That 20% expansion means your company could stop selling entirely and still grow 20% year over year. The early aha moment hits when you realize this flips the hierarchy of metrics upside down. Acquisition no longer leads the show. Expansion and retention do. In a product-led world, new customers build the floor, but existing customers raise the ceiling. When your base expands faster than it leaks, revenue becomes self-propelling. A company with 130% NRR compounds at a rate that doubles its core revenue in less than 3 years without adding a single new logo. That is why investors chase this metric like oxygen. Think about how this changes behavior inside the company. In a low-retention model, marketing and sales are an addiction. You need constant injection of new customers to stay alive. In a high NRR model, every existing customer becomes an asset that appreciates over time. Your sales team can focus on quality over quantity. Your product roadmap aligns around expansion points instead of first-touch features. Your customer success team becomes the true growth department. Here's the hidden math behind why it matters so much. Imagine two SaaS companies, both starting with the same revenue and growth rate. One retains 90% of its base each year. The other retains 120%. After 5 years, the difference between them isn't 20 or 30%. It's almost double in total ARR. Compounding expansion inside the base multiplies through time in a way that linear acquisition never can. The paradox is that the companies most famous for fast top-line growth often mask mediocre NRR. They sprint to impress headlines, not cohorts. But the elite ones, the ones that quietly become institutions, obsess over the retention curve. They know that a small percentage change in NRR shifts the entire trajectory of enterprise value. A jump from 110 to 120% can add billions in market cap because it signals not just revenue but resilience. Here's a striking insight worth remembering. SaaS companies don't grow because they sell more software. They grow because their customers do. When your customer's success directly expands your own revenue, you stop fighting churn with discounts and start building products that scale with the user's ambition. The better they do, the more they pay you, not out of obligation, but because the tool becomes inseparable from their daily workflow. That's not a renewal, that's symbiosis. Now look deeper into what fuels those expansions. It's never random. It's product design that unlocks natural growth levers. Usage-based pricing that rises with data volume, seat-based pricing that grows with team size, feature-based pricing that expands as the customer matures. Each design converts success into spend. NRR captures this hidden engine in a single number. When it rises, it means you're not just winning new users, you're growing with them. Micro-reset the lens and notice what NRR says about risk. In downturns, companies with high net revenue retention keep compounding even when acquisition stalls. They've already earned the right to coast for a moment because their existing base keeps the lights on. In contrast, low NRR companies see gravity hit fast. They depend on continuous demand to cover churn, and when that demand slows, their entire model seizes. Here's the counterintuitive twist. A company with lower overall growth but high NRR can be far more valuable than one with flashier revenue acceleration. because one is building durable cash flow while the other is sprinting on a treadmill. Net revenue retention isn't just a metric. It's a mirror of truth. It exposes how much real momentum the business has when no one is buying. Now bring this to the capital markets. Investors don't just look at ARR anymore. They price recurring predictability. Two companies with the same revenue but different NRR will command vastly different multiples, because one represents a machine that self-compounds, and the other represents a machine that leaks value the second spending slows. That's why you see SaaS companies with modest profit but massive valuations. They've proven that their customers not only stay, but expand relentlessly. A hidden engine of SaaS is expansion within the base. Churn control is survival, but expansion is dominance. It turns every sale into a seed that grows over years instead of months. When that pattern becomes predictable, a company doesn't just sell subscriptions, it sells continuity. And continuity is the rarest currency in business. Here's your takeaway for reading SaaS companies like an insider. Stop asking how fast they're growing on paper. Ask how much their base expands each quarter. Ask whether that number sits above 120%. Ask whether they can pause sales for a month and still grow, because that's when you know the math has crossed from momentum to inevitability. If this breakdown sharpened how you see SaaS economics, like the video, subscribe for more cinematic dissections of software business models, and drop a comment telling me which metric or company you want unpacked next. And when you're done here, watch the next video in the series where we continue to dive into more SaaS breakdowns.